Uh, well, boys, better late than never. Welcome, everyone, to the 5-Year Career Podcast. This is episode 52 of the 5-Year Career Podcast. Today's topic is about prices. It's about problematic situations that are happening in today's real estate. It's about the real world, what's really going on in the minds of thousands of real estate agents across the country. But before we get started, I want you to imagine, if you can, starting a real estate business that creates massive leads. We bleed leads. That's who we are. That's what this podcast is really about. Quality, consistent leads that allows you to create a business that in 5 short years will allow you to actually do what you want. 5 short years. But that 5-year career business is really important to discuss what it is, a real quick overview. It's doing personal transactions, 12 or more, 12 to 24 every year, creating a small team or a bigger team that allows you to have indirect income. You take off to Europe for a month, you want to have somebody running your business while you're gone. Third thing is buying stock in a company, if it happens to be a company that allows you to buy their stock ownership. That's really important. And last but not least, buying one piece of real estate every year. I see many real estate agents that find great deals for their clients, but never buy the real estate themselves. So that's what we're about. And if you want to know more about us, you can simply go to our YouTube channel. For the past 52 weeks, you'll find great information about how to create leads. That's, again, what our primary purpose is. But today, in the next 30 minutes, we're going to address some issues that are real issues for real estate agents. By the way, I'm still standing after 5 crises in the real estate world. Let me identify what those are. The first was the Great Depression. After the Great Depression, we had the war. World War II. And in World War II, when people came home, there was no housing for them. People stopped building for many years. The expansion of cities into the suburbs. After that, in 1980s, savings and loan crisis. Huge, 21% interest. And then we come to one of the more serious crises in my life, which was 2007 and 2008. I call that the change of policy of the federal government toward lending, but what really caused it was aggressive, over-aggressive lending that caused traumatic problems for everyone in the real estate industry and people who own real estate. So all of us, we're still standing after. By the way, I wasn't in the Great Depression. I just want to clarify that. And I wasn't in World War II, although some of you.
I was going to ask, how many of those were you involved in? And I'm not throwing blame. I'm just asking how many you were involved in.
Hey, eliminate the first 2, and I'm still standing. All right. And today we're going to cover some topics in particular, how the market has shifted, and are you really standing as a real estate agent on solid ground? Are you complaining or embracing the changes that you need to make? And will the 5 skills that you learn every week on our podcast, the 5-year career skills, how do they apply to helping you with the changes that need to be made in order to survive in today's real estate world? And finally, do you want high results? You want low costs? Do you want to stop guessing and have solutions to your problem? That's what this podcast is about today, addressing the issues that are obviously forthcoming in the real estate market of 2025. And to do that, I have my 2 great partners. Patrick, you've been in the real estate business for as long as I've personally known you. And Patrick is an expert on foreclosures, bankruptcies, which are about to happen, and also affinity marketing. We call him affectionately Mr. Go Vertical. And that is a sleeping giant that we're going to expand on in 2025. It is a huge, enormous profit center for real estate agents. So Patrick, welcome to the call. And then, of course, the automatic landlord, who I've known forever. I think I've known you since you were born. But the bottom line is the automatic landlord, Eric Wilner, who is the host of the longest running radio show in the country called The Real Estate Show, and is also the guy that you want to know when you're ready to buy one home a year as a real estate agent. So welcome both of you to the call. So as we get started today, I want to, Eric, I'd like you to take over and kind of talk about Florida, because all of us live in Florida. You live in lower New York, down in the South, and I live in LA,
The
lower
sixth borough.
Alabama, up in the northwest quadrant of the state. But let's talk about Florida in general and the trends in foreclosures. What are we seeing? What can we expect in 2025?
Well, the first thing I would start off by saying, the economy is the economy, right? It's the gross, it's the national economy. There's nothing we can do about it. But we also have our own economy, and that we are very much in control of, and we can affect. And a great entrepreneur sees every shift in the economy, whether for the upside or the downside, but in change, which is what's going on. Crisis is another way of saying change. There's lots of opportunity. And so the truth is, rather than, get all, your underwear up in a bundle because of all the headlines, take a step back and then look at what we're going to talk about, and then look, where is the opportunity? Because as you started out saying, leads are the lifeblood of any business. We bleed leads, but in every crisis, turmoil, or transition, there's going to be a lot of new leads. The question is, how do we go get them? So we're in this market of shifting sands, right? And the question that you have to ask yourself, and when you take a step back, I think you can answer it positively. Are you standing on solid ground, right? Do you have the right tools in place, the right education in place? Do you have the right mindset, right? Because it's tool set, skill set, mindset. And don't just complain about the challenges. Quite honestly, most of us, when we see an impending softening of the market, as the automatic landlord, I'm going like this. I go like I'm about to take another major step up in my portfolio. The question now has, since you're listening to this podcast, is, will the 5-year career skills apply to this changing market? And I think you're going to want to pay attention to today's podcast, because this is what we're really going to focus on. And finally, if you want high results at a low cost without guesswork, but following a proven color by the numbers roadmap, then you're in the right place at the right time. So back to you, Skip.
Yeah, Eric, what are the foreclosure rates in Florida now? I read that 1 in every 267 housing units are affected by foreclosures. Are we seeing an increase, boys? Are we seeing stability? For the past couple of years, there haven't been a lot of foreclosures, but to me, it smells like foreclosures are about to explode. Either one of you want to comment on that?
Yeah, I'll throw something in the ring on that too. Is after the previous crisis to the one we're kind of in right now, 2007 and 8 that you brought up, Skip, the Consumer Finance Protection Bureau was created, and that was an oversight committee essentially to ensure that what transpired that caused that meltdown, which was fraudulent loans, over aggressive lending criteria, subprime programs, et cetera, that there was some semblance of sanity in there. And one of the elements of that whole guideline was that banks really had to do everything in their power not to foreclose. So defaulted files built up and built up and built up, and it really created a whole bunch of tension. But today, not nearly 15 years later, the guidelines are very clear as to what needs to happen. And the banks are now beginning to go back through the foreclosure process, because that is truly their only out when a homeowner, when a borrower stops paying their mortgage. That collateral is the only thing that they have. I do have some really close friends in the industry, and they are saying for sure they're seeing the uptick in defaults.
That's good.
Yeah,
What about,
and I think the important thing is that there's leading indicators, right? And foreclosures per se, are still within normal ranges. So everything looks good, you know, right close up front. But if you look a little bit further out on the horizon, mortgage delinquencies are up, automobile delinquencies, which is rare, are
Mhm.
up. So there's a lot of cracks, if you will, that you're starting to see. And this is one of the reasons why, being part of the 5-year career community, you're going to have people with high level access to information
Mhm.
and, you know, a lot of years of wisdom seeing this kind of stuff. And
Yeah.
to what Patrick was just saying, I remember when the market first collapsed, you know, in 2008, and it happened pretty fast, right? I mean, we would go to closings and then find out that the approval was rescinded, that the money wasn't coming, even though
Mhm.
the mortgage, you know, the closings were scheduled. And then all of a sudden, you know, people were didn't make payments for a month, 6 months, 12 months, and people were saying how stupid the banks were. Let me just make two comments about that. Not so much, right? They were the first to recover, the fastest to recover, and they still have the best real estate, the best buildings, and are, you know, are immensely profitable. What they did is, when they let people stay in the homes, you were free property management for them, because it's true, they got an onslaught faster than what they could absorb. So it was easier to leave a homeowner in there to protect the castle and maintain it than it was to take it, because they were going to take it anyway, right? That
Exactly.
was the issue. Number one. Number two, at that time, big banks and big hedge funds were not interested in single family homes. The big money went into multifamily, commercial buildings,
Commercial.
and they didn't really have how to manage separate rooftops. Not true today. So when this, you know, increased delinquency starts to ferret out into foreclosures, you're going to see things happen a lot faster, a lot more efficiently this time. So back to you guys.
Yeah, I have a question for either one of you. What's a zombie foreclosure? Anybody want to comment on Patrick? You want to comment
Yeah,
on
sure.
zombies?
Yeah, so by definition, a zombie property is a property that has been vacated by the occupant. So it's a vacant
Mm-hmm.
home. And to
Uh-huh.
Eric's point, it's no longer being property managed for free by anybody. And the
Yeah.
lender does not have ownership in the form of an REO. So they can't do certain things themselves either, because they don't own the property. So these properties tend to go through some pretty rapid wear and tear and physical decline, which makes them tremendous investment opportunities. And part of the underlying theme of today's episode, and we'll probably have to dive deeper on another one, but is where the opportunities lie in this
Mm-hmm.
shifting sands economy and market that we're in. There are some huge opportunities out there. And so, Skip, zombie properties just being one of them.
Well, next we're going to move to a different area that I can smell it, I can see it, I know it's there. It's just not being talked about as much. And we just one other reason why those big smart banks didn't want those properties back is the liability. Even though they weren't getting money, the properties were being maintained, but they didn't want that asset back on their books because they knew it was worth far less than what the loan was on that property in many cases. And so they just said, okay, keep it over there off of our books, because it would impact their financials dramatically if they continued to bring back all these properties that were on, what is it called? Non-paying assets. Yeah.
Yep.
Yeah, on their books.
Non-performing.
Okay, so Patrick, talk about what I see is a huge segment of the market that's about to come, and that's short sales. Because of anybody who bought in 21 and 22 paid a ton of money for real estate, 40% increase in property values. What's going on with short sales?
Okay, so
And I had a
funny.
question.
No, fire away, Eric.
A short sale, is the realtor short or is the homeowner short?
Well,
Oh boy. So I'll tell a very quick anecdote, and hopefully this is politically correct. But back when short sales first emerged as a thing in 2007, a gentleman that I worked for who owned a little company called foreclosure.com started a company that began to sell short sale properties. And at the Mortgage Bankers Conference, he was looking to make a big splash, and he hired a whole bunch of, shall we call them, little people to wear T-shirts saying, "I'm not a short sale, I'm a
I
quick
saw
sale."
that.
And that To this day, I hear stories about that. But anyway, Eric, no, it's the short is on the mortgage. But guys, I've been doing short sales for a long time. As you know, we started a company back in 2010 called BK Global, which did nothing but sell short sales for bankruptcy trustees across the country. And that was a wonderful time because we saw the CFPB guidelines tighten up, processes becoming much more predictable, and being able to get short sales done methodically, not some magical, please, I hope the bank gets this one through, which it was in the early days. Well, today, Skip, you're 100% correct. What I think the most important takeaway from today's video podcast is that the old days of being an REO agent and having lots of them are pretty much gone. There's still REO agents making a good living, but because of those guidelines back in the day, banks would prefer another loss mitigation solution as opposed to foreclosure. Short sale is very high on the list because in many cases, these properties have become deteriorated and shop worn. They don't really want that asset on their books. If they can sell it short, there's all kinds of financial benefits for them in the background, especially for the loan servicer. And of course, loan modifications are still in vogue, although the reasons why people are in default usually prohibits them from getting a loan modification. So I'm actually doing a lot with short sales right now, and they are absolutely here and a great opportunity for real estate professionals. And by the way, in our 5-year real estate career, I know we talk about first-time homebuyer webinars, but if you're working with local employer groups or you've got a social media presence out there, you could do a webinar on being in financial distress. I can tell you that there's a huge audience for that and begin to develop abundant leads there as well. And folks, you've got an entire team here, the three of us, that can help you navigate through those properties. But specifically, there were, in fact, I did a research in the South Florida MLS. There were only 27 short sales. And we did this a few months ago, guys. However, there were about 10 to 15 times as many properties that were over encumbered, not listed as short sales in the multiple listing, because the real estate agent and the homeowner were hoping they could list the property above the mortgage balance, and they've been on the market for a long time. Folks, those are short sales, and there's a huge opportunity with expired listings and canceled listings for those very reasons to come in and pull them out as short sales. But in 2024, there were 327 short sales registered in the state of Florida, which was a 21.1% increase from the prior year at 270. The median sale price for these properties rose 13.5%, but they were still, as you stated, Skip, upside down. So a tremendous opportunity. And this uptick in short sales is just indicative of the fact that there is a financial crisis in this country still, not only for affordability of first-time home buyer homes, but sustainability. When the people, you nailed it, Skip, in the last couple of years had bought at the peak of the market, if anything goes south on them, and if they had a high loan-to-value mortgage, they are short. And if they need to sell their property, it will in fact be a short sale, for sure.
Absolutely, without question. There's just a lot of what I call zombie short sales that are out there that people aren't really thinking or talking about it. And in markets that were about to come, I just want to talk to the buyers. If you're a real estate agent, you need to be talking to the buyers. Don't worry about the interest rates. Interest rates are what, Eric, you always talk about. You have a statement about interest rates being temporary. I forget exactly what you.
Oh, the old marry the house and date the rate.
Yeah,
cliche.
marry the house and date the rate. Because here's what's going to happen. It's time for buyers to get back in the game as long as they can afford to buy, because don't worry about the rate. The rates will come down eventually, but there are opportunities that did not exist as little as a year ago. Better negotiating skills with people who are in trouble. And we didn't talk, one other huge factor that I think is credit card debt. Credit card debt is the highest it's ever been. And that eventually comes back to haunt people who have properties that they bought with maximum LTVs. So we're headed into a opportunity.
Don't forget student loans. That's the other big elephant in the room. In fact, think about, and I know nothing about this, and I'll just admit that up front. But think about all the people who are expecting the last administration to forgive their student loans that maybe stopped paying or became delinquent on
Yep.
those payments temporarily, that now are under, again, that big stress of a big, payment and a big balance that's
Yeah.
looming and prevented.
Before we move on to our next segment, you really nailed it. One of the things that we saw when doing bankruptcy sales, and oftentimes the federal trustee says, well, why would I want to sell the debtor's home? They're current on their mortgage. And yet, if you looked at the bankruptcy schedules, which had their income, their expenses, their assets, it was clear that they were living up to the minute on credit cards.
Credit
And
cards.
the last bastion of anything that they were paying was their home. And we tracked many of these that we recommended for sale to the trustee, and they said, no, no, no. They went into foreclosure. So imagine filing bankruptcy to protect yourself financially, and then you end
There you
up
go.
with a foreclosure on
Uh,
top of it all.
That was a
That,
really
and
common, that was very common in 2009, 10, 11,
Yep.
and 12, when you had that huge uptick in property values and high LTVs. The temporary, that's all the bankruptcy was,
Yep.
temporary before they lost their home. Yep.
And here's another thing to think about, Patrick, is you just brought up another. Twice this week on my radio show, I received callers from people who the credit card companies, when they see you getting close to your limit, they already lower your limit.
Yeah.
And so credit card companies, which didn't used to do this, are now, when they see, and they've got computers to alert them, when they see that the values and that there's an upward trend, they know what the statistics have told them, and they're mitigating their losses up front. And so the person who's living off the credit cards might come to a very shocking realization that there's no more left sooner than they think.
Yeah, exactly. And credit card debt today, as high as 36% for some credit cards, the
I've seen
Targets of the
40s.
world. Yeah, it's outrageous. Anyway, let's move on to the next potential opportunity for real estate agents to make some serious money in 2025. And I call that the Florida condo market. Gentlemen, 2025, what's happening to prices in Condo City, Dade, Broward, and Palm Beach County? What's going on with the condos down in your market first? Are they going up in price? They're going down in price? Talk about that a little bit. Are there opportunities? Either
I'll
one of
jump
you.
on about two things that I see in the condo market. Traditionally, right, when real estate was normal back in the day, when interest rates 6 to 8% were considered normal, when the regular market was considered normal, that 30 to 90 days on the market was considered normal. Condo prices were about 70 to 80%. I'm talking about dollars per square foot as a single family house, right? Condo houses always had a premium, but when we got into this shortage of the low interest rates and low inventory, I saw condos become level with the dollar for dollar, and I'm going like, how can that be? And now two factors have risen their heads, and this is where, like you said, opportunity lies. Number one is there's a new law called the 40-year inspection rule. So older condominiums that weren't doing their proper maintenance over the years have to have an inspection when they reach their 40 years. And this inspection has been revealing, and we had the big condo collapse issue. So it's very much in the forefront. So now a lot of condominiums are having to special assess for the maintenance. And so what you've seen is the condo association fees jump up dramatically. And especially in areas of fixed income, like the Century Villages and those kind of places where people were okay where they were, but not okay where they are now, they're going to be forced to sell, number one. Number two, it directly impacts the qualifying ability of a person, because part of their qualifying ratio, the housing payment, is the condo fees, if any. And when you now have regular condo fees of 800, 1,000, I was just looking in a luxury condominium where they're charging $1 a square foot. And think about a 3,000 square foot condo with a $3,000 a month. That's the mortgage payment already twice.
Exactly.
Yeah,
Patrick?
and I'll tell you, I don't claim to be an expert in this space, and I have as many questions as I have answers for sure, because all of these things that we just talked about, that 40-year inspection, thankfully, is now being required, because we did see the tragedy at Champlain Towers in Sunny Isles, Florida, where the whole building collapsed. With that, though, to Eric's point, some of these assessments to fix things, spalling because of saltwater intrusion just from the air in the beachside properties, all of a sudden result in huge special assessments of tens of thousands of dollars. And many of the residents cannot afford that. In fact, there was one building in Fort Lauderdale in South Florida where the residents all got together and said, we're all out. And collectively, they sold all of their rights to everything to some developer who's going to, I think, tear the building down and build a new one.
Absolutely.
And that wasn't a windfall for them. I think they got out with the skin of their teeth. But the point being that, that's a big deal. And if an entire building goes, let's call it upside down financially because of the need for all of these repairs and special assessments, well, who is going to be the end user buyer? Will there be people coming with lots of cash from other markets that don't see that as a problem? And it'll just be a gentrification, for lack of a better word, of that condominium building? Or will there have to be some form of subsidy from the state, the federal government, the counties to offset some of these? And I don't know the answer to that, but I would say for sure, in my universe, if I was working with a buyer, I would definitely caution them to be very, very inquisitive about the financials of that building. How old is it? When was the last time it was inspected? Because there could be some big surprises down the road for you. Now, as far as it becoming an opportunity for investments, there may well be. I suspect we're going to see a ton of shorts in the condominium market.
Absolutely. Well, there's two things that I just want to comment as we close about the condo crisis, especially in Dade Broward. Number one, decreased property values. It's sad, but people who bought in 2020, 21, they're going to lose money when they sell today, because the press is eaten alive condo owners in Florida talking about all the challenges. And whenever you have buyer hesitancy, people who say, oh, I was going to buy a condo on the beach in Florida. Now I want to get as far away from that as humanly possible. I still want to move to Florida, but I don't want a condo on the beach anymore. You're gonna see prices decline, and I think quite rapidly over this next couple of years. And that creates an opportunity for real estate investors and people who have enough money to cover the potential expenses, who will buy at a much better price than what they would have bought a couple of years ago. You guys agree with that?
Yep.
Very much so. And so let's always look at the opportunity, because one thing that I was just thinking to myself that is in common, we talked about the short sales, we talked about the condo price readjustment that's coming, right? Both of those, think of this as a listing agent, right? An improperly priced listing, what is it worth? Nothing, right?
Nothing.
It's nothing but a waste of time and fuel for dissatisfaction. And so this is the time to get good at valuing properties and get good at explaining what's going on, because why would you want an overpriced listing? I remember, back in the first short sale wave, people were putting properties on the market for the loan balance, which had nothing to do with the market value. And those properties sat. Sellers getting nervous, getting upset, thinks their realtor isn't doing anything. The buyers are looking at it and saying that they're crazy, they're incompetent. So one of the big takeaways right now, this is a great time, okay, to become an expert, to become very proficient at valuing properties based not only on past sales, but here's the cool thing, right? Typically, listing prices are higher than the past sales. What you're going to start to see is even the other way, which is a leading indicator of the trend. Until that changes, you want to be schooling your sellers how to best navigate those waters.
Yeah.
Yep.
And just one other comment about that. There's 27% more listings in the state of Florida than there were at this time last year. That alone tells me prices are not headed up any longer. You're going to have buyer opportunities that exist because of a growing demand of sellers to sell property. And the one other thing, the ugly part of being a seller today, unfortunately, is that you're competing against all the new construction people who overbuilt, and now they're your fiercest competitor because they're buying down the interest rates, they're paying all of the closing costs, they're reducing the prices on their closeout properties. Well, this all causes the market to change significantly. So we're in a problematic market, but what all of us need to understand, there are always ways to make money when there are problems. Right or wrong, guys?
100%.
Problematic equals opportunistic.
Yes.
All right. So as we close our meeting today, I want to close it with a thought about what we're about at the 5-year career, and we're all about leads. We bleed leads, and the way to do that is through our webinar program. Each month, we produce 2 webinars on 4 topics: first-time homebuyers, new construction, how to buy your first investment real estate. And our 4th webinar, which will be rolling out very soon, is how to use affinity marketing to create massive leads for real estate agents. So we do it for you. Everything is laid out so that it's really simple, and it costs almost nothing for a real estate agent to be able to participate in our program. We call it Pay As You Close program. So we hope that today brought some great value to. What we want to do is connect with you and share an opportunity for you to be able to participate in our Do It For You webinar program. It's the best thing. And I'm going to illustrate. I lived in Boca Raton for 37 years, moved to Pensacola a little bit over 2 years ago, took a year, mastered my golf game, didn't work a stitch, decided 1 year ago that I wanted to get back and start selling real estate. What did I do? I did one thing and one thing only. I started running webinars to help first-time homebuyers. And that series created leads for me. Massive leads, which I've been able to convert to buyers who have bought first-time homes in Pensacola. So with that, everyone, we want to thank you for attending our weekly podcast. Come back next week with another exciting idea that we have to help you create massive leads. Thank you so much for joining us on our 5-year career podcast. We're happy that you join us each week. Make it an awesome day. And if you happen to live in Florida, make it a sunshiny day at the beach. Bye.